All right, guys, I wanted to do a video for anyone who's interested in the opportunities in the stock market right now, because there's a lot of people out there saying, well, the old investing's dead and, you need to get with the times and you need to jump on this or jump on that. And they're selling some quick fad, some quick fix. And the truth of the matter is, right now, this is the best time ever in my life and in my investing and trading experience to take advantage of enormous opportunities in the stock market. And I want to kind of, the goal for this video is to share with you enough information so that you can stop and think, wow, that I really can do that. And I can see where the opportunities are now. And instead of taking a punt or a tip off of Dave down the pub, I'm going to actually nail this stuff so that I can really make the most of the opportunities right now. Okay. So if you watch to the end, I promise you're going to be in a better place than I found you. All right. So with that being said, let's talk a little bit about the stock market, right? So most people approach the stock market and they go, right, what stock's good to buy? And they'll ask their friend, ask their barber, ask their friend, ask their colleague, and they'll go, oh yeah, well, tech stocks are doing well, or this doing well, and that's doing well. Let me just tell you a little story, okay? Let's just, first of all, let's paint a little picture for you, because you can see that, Meta's crashed and Microsoft's crashed, Amazon's crashed, Netflix crashed, all these kind of things. Let's just take a little step back a little bit. This chart here represents the last 50 odd years of the S&P 500, which is basically a pool of the top performing 500 companies in the world. Okay. And you can see that they go up over time because that's innovation. And all of these little companies inside this pool of 500 grow over time. But there's also times where there's an extension and a recession, a depression. Okay. And this red line that you're looking at down the middle is the mean growth of the market. Some of you have heard of mean reversions and things like that in the stock market. That red line represents the mean growth over those 50 years. And the chart is the price action, right? So you can see there's times where it's been overinflated and there's times where it's been depressed and crashed below the mean. But what we're trying to do is approximate that mean growth of the market and see where the opportunities are in that, okay? Now you can see just after COVID, we had about a 22% above the average, above the mean growth, and then we pushed down about 20%, and now we're around, pushing on our way back up there. Now, let me explain what really happens here, because when you go onto a stock screener like this, there's a lot of information. And what most uninitiated traders do is they look at this technical rating and they go, well, I'm just going to buy the ones that say strong buy. And they have no idea why they're buying it. Okay. It's like me saying, oh, you should drive a manual car because it's better than driving an automatic car. And you don't question it and you just do it. And then it's me, you got to get on the property ladder. That's the American dream. And you buy a house and you're stuck with a mortgage or whatever, right? So let's just start questioning things, first of all. And the reason I want to start with this is because you have to understand why something is a strong buy or why something is not a strong buy. And I also want to paint the picture of what's happened in the last few years, because let's go back to COVID. In COVID, it's a massive thing that happens that people are like injects uncertainty into the world. And whenever people are uncertain, they crap themselves a little bit. And they're thinking, right, okay, I better pull my money out of this and I need to think about what I'm going to do with my money. And obviously COVID was one of those things that's unprecedented. It's never happened before or to that degree. And people start being a little bit scared. So what we see is an influx of people being stupid with money. Okay, so we see furlough checks come out and bounce back loans being lent to people, this fake money being printed into the economy for people who need it, right? So people who need it haven't managed their money until that point, bear in mind, so they're not good with money. So then they go and spend it on lots of different things like Range Rovers and, trying to patch up a business that won't work through COVID. So they're trying to do old strategies onto a business that won't work. They start going to buy NFTs and baseball cards and crypto and all this kind of stuff, all this speculative stuff. And then guess what? They figure out very quickly that doesn't work. So then they think, right, now I'm going to go and buy something safe, right? Bear with me. So they buy something safe. What's safe? Technology, innovation in technology, property, okay? And then we see the house prices rise. Who's seen the house prices rise dramatically over the last couple of years? Right. Because people put their money into things that they feel safe. Tech companies, they're all considered safe stocks because they are innovative. They're tech, right? It's innovation. It's always growing. So people go, I'm going to put my money into tech stocks. Well, whilst that happens, the property market and the estate agents and the tech companies like Facebook and Twitter and, all the tech companies have a whale of a time because they've got this astronomical growth. They get all of the shareholders' money and they say, we can use this money to now go and employ lots and lots of people. And, we can grow the company astronomically very quickly. Then what happens is we get to a point where the price for a stock is too high and the value's not there anymore. So just like property, okay, the property price goes up and up and up. And there's a point at which someone will say, that's not worth that to me. And they won't buy it. So they'll pull their money out or they just won't buy anymore. So that's what's happened with the stock market. We've seen that happen, right? So now the value's gone out of the tech for a time being. People didn't want to pay $340 for a Microsoft stock at that time. So now they start pulling their money out. And guess what happens then? They all have to lay people off. We've seen Disney lay people off. We've seen Facebook lay people off, Amazon, right? Meta, all these companies laying people off left, right, and center because of this very thing. People pulling their money out of what was a safe stock, realizing it was overvalued, and now, getting their money back out. Okay. So now they don't have the money and they're like, right, we've got to let you go. And you've got to reduce costs. Okay. That's what happens. Now, it doesn't mean that this isn't a good time for investors because you could pretty much throw a dart at any of these tech companies now and do okay, right? Because it's going to go up. Some of the big companies, they're going to continue to grow and they're innovating whilst you're asleep. And great, you're getting a low price. Instead of $3.50 a stock, you're getting in at $2.30, right? Amazing. So that's great. But what we really want to understand is going back to what I just said about how people work, right? Because human evolution hasn't really changed. In terms of how we think, we haven't really changed a lot as humans for about 6,000 years. Okay, so going back to timeless and universal principles of investing, think about this. Whilst all this stuff's been going on and COVID and the safe stock being overvalued and all this kind of stuff, what's likely to be at the forefront of good investments going forward? Well, you've heard me say this before, but I'm talking about things like finance. Loans aren't going to go anywhere. People are always going to be loaning money. Okay, we're too deep in the thick of it to not be loaning money. There's money owed everywhere. Okay, so finance, we're not going to stop loaning from banks and things like that. The other thing is transportation. People aren't going to stop traveling and transporting goods and things like that. And another one is energy and renewable energy minerals and things like that. Those should be innovative, right? They should be innovating. So those kind of companies that are timeless, they're the ones that take a hit during the time where everyone's scared because we stopped traveling. The banks tightened up and everyone's like, well, they're lending money to everyone. That's probably not a good investment. And energy prices, we're seeing the energy prices rocket now, but there's a kind of a shake-up. But if you think about it, they're the ones that are going to pull through. They're the ones that are going to come out on top. So whilst they take a nosedive, then you want to consider, well, how do I get involved with these going forward? And then you look at a stock screener and you see all of these things. Okay, you see all of this information and you think, where do I start? And what this stock screener is basically a ton of information on a company. The first place you need to start when you're investing in the stock market, and this is the first thing you need to learn, okay? And it won't only help you in the stock market, but it will help you in your own business. It will give you an edge in your business. And most business owners don't understand it, believe it or not, because they're entrepreneurs. And the most important thing you need to understand is the financial statements. Now, don't let that phrase scare you off, okay? Don't let that phrase scare you off because it's not scary. It's very easy to understand 3 financial statements: your income statement, your balance sheet, and your cash flow statement. Let me explain what each of them are. The income statement is, think of it like income versus outcome. So imagine your bank account, the income comes in and the expenses go out, and then the earnings are left over at the bottom, right? That is the profit. That's your income statement. The balance sheet is like your net worth, because it's assets minus liabilities. And whatever's left at the bottom is called equity. Okay, so you take off, your house value minus the mortgage. That's the equity in your house. The same goes for every possession that you've got. That's your net worth. Same for business. Everything they own is an asset. It depreciates in value over the years, obviously, but the equity is kind of this dynamic figure that keeps adjusting each and every year and balancing out. The cash flow statement shows us what from the income from the income statement, the earnings that are left over, how that is being used in the business. And from that, we can see how they're increasing their assets, how they're reducing their debts and liabilities, how efficient they are at using money. So how much they have to spend in order to generate a profit. Okay. And things like that. And that's really it. Like those three statements, that helps us start to form a story. Then we just need to know a few little, key points of information, such as abbreviations, which you see across the top column on this stock screener here. Things like earnings per share, things like book value per share, things like price to earnings ratio, price to book ratio, earnings yield, return on equity, return on invested capital. Those kind of abbreviations, once we understand what they are and what they do, then we can start to really look at and form a story of what the company is, the stature of the company. Okay. Because a lot of people say, well, Toyota's been going a long time. It's a massive company, a big successful car company. When you look at Toyota, they have to spend all and more of their earnings every year to produce the profit, to produce the overheads. Okay. So they're not even in profit. And it's a snowball. Think how many employees they've got. And they're just hoping that they turn it around now, because slowly that is going to decline over time, and the company will go bust if they carry on how they're going on right now. And the numbers don't lie. The numbers are there. This is all public information. A lot of people were getting into Tesla when Tesla wasn't earning any, hadn't earned a profit. And it's the same thing. People just get in of buzzwords. I don't want you to get into buzzwords. What I want you to do is I want you to understand some of this stuff. Now, I'm not going to go into Yahoo Money, Yahoo Finance, and look at some of the numbers. I've done that in many other videos, and you can go and check those out. But what I want to start with is just kind of how to start filtering down. Because look, you can see here, right, we have got 8,103 companies in this stock screener. Okay, that's going to take quite a while to filter down. Okay, you're going to go through each one. Or you're going to, even if you just go through the buys and the strong buys, if that's you, it's still got thousands of companies that you're going to have to go and analyze. That's going to take a long, long time. So first thing, let's start applying some filters, right? Let's just say, well, okay, the market cap, the market cap of the company, I only want to look at companies that have a market cap of 500 million plus. Okay, so we'll put a little... 500 million plus, and great, we've got now 1,000 companies. Okay, instead of 8,000, we've got 1,000. That's pretty good. That's pretty cool. So what else can we do? Well, there's something called price to book ratio and price to earnings ratio, and what they are is the price to book ratio is your margin of safety, and the lower the price to book ratio, the better. And if you've heard of Intelligent Investor, Benjamin Graham, he looks for a price to book ratio lower than 1.5. But what it basically means is if the PB is 1, for every dollar that you pay, you're buying $1 in equity. Okay, so it's match for match, like for like. Okay, if you're paying $1.50 into the stock, you're getting $1 in equity. Okay, so the higher you go, you're getting less equity for your buck. So it's a margin of safety. Make sense? And then the price to earnings ratio, which is PE here. Again, Benjamin Graham likes a low PE ratio, ideally below 15, because it means for every $15 you pay, the company makes $1 in profit. Okay. And then if it's lower, every $10 you pay, it makes $1 in profit. So basically you're putting less in to get more earnings. So whilst the PE is an earnings thing, right? The PB is a margin of safety. So with those two things being low, and Benjamin Graham, if you've heard of the Graham number, he says, if we're looking for a PB less than 1.5 and a PE less than 15, well, simply multiply the PB by the PE and look for companies that have a Graham number of less than 22.5. And you'll see that on Intelligent Investor. They wrote about that in the book. Okay, so there we go. We can start to go, okay, let's say we want a PB less than 1.5. Okay, and we want a PE less than 15. Great. Now we've got 87 matches. That's pretty good, right? Cool. Coffee. Now, what else can we do? Think about this. When you're looking for a stock, what about dividend yield? Dividend yield. Okay. You're going to want a payout. That's the whole point we're investing in stocks. If you're value investing, I mean, putting your money in, and you want the returns for passive income, which is what everyone's chasing, and this is how it's done. Passive income isn't buying a stock and then selling it and then putting the money in something else, selling it. That's not passive. That takes a lot of skill, a lot of time, and you have to be on top of it all the time. That's not passive. Okay, that's just a business. That's just doing any buying and selling. That's a trader, a market trader, whatever, right? So passive income comes from dividend yields in stocks. So we want a dividend yield. So in other words, we want a dividend yield. We want to look at companies, ideally, that offer a dividend yield above zero. Okay, so we're at least above zero. We want to start looking at companies that go above zero. Now, what that's left us with is out of 8,000 companies, we've now got 60. Still quite a hefty, that's 60 stocks to analyze. That's still quite a fair whack of companies to go through. Okay. Now, there's two main methods that I use on my own investing. One's called Magic Formula. Okay. And if you're familiar with the book, the little book that beats the market, in there it talks about Magic Formula investing. And it's essentially where you rank all of the companies in a stock market. So not 60, but 8,000 or however many there are in the stock market that you're analyzing. And you rank them 1 to however many thousand based on return on invested capital. The next thing you do is you rank them again based on earnings yield, 1 to however many thousand, right? And then you've got two lists. Then you sum up the two ranks, and then you take the top 30, and then you perform something called qualitative and quantitative analysis to give you the top 5. And then there's a strategy for buying those over a period of 12 months. And then you sell off the winners and sell off the losers on the 12th and 13th month. And then you do it again the following year and the following year. I can talk a little bit more about that at the end, but that's the Magic Formula. And then there's the kind of more Warren Buffett, Benjamin Graham value investing approach, where Warren Buffett talks about his tenets of investing, and I'll talk to you about those in just a second. And that's kind of what we're looking at the moment. We're trying to drill down and figure out what is a company that we'd love to own for a long time. And in order to do that, it's not just about the quantitative analysis and the numbers, it's qualitative analysis as well. Okay. And that's something that people neglect. And then when they neglect that, it plays against their own emotions and who they are as a human being, and they're unable to invest in it sustainably because it's going against the fiber of their being. And that sounds a little bit fluffy, but if you are an investor watching this, you understand completely what I'm talking about there. You have to pick stocks that align with you. All right. If you're not, you're trading and you're punting, like I did with Moderna. Back in lockdown, I used this analysis, and then I went into Moderna, and I can't find them now, but I got about 67% return in a month. mRNA, I'll show you if it's still on here. Probably still is on here. Let's take a look quickly, and then we'll get straight back to it. Yeah, there. That was where I got in. So I traded this, and again, this was a trade. There was my trade. Look, there we go. They were just on the brink of, coming through of a vaccine when all that thing was, believed in, and I got 67% return. If I held that, great. You know, if I was value investing in Moderna, I would have done a lot better. But that was a trade. That wasn't an investment. And I risked no more than 1% of my total portfolio liquidity. Okay. I think I put about 2.5, 3 grand, 25 or 30 grand into that one trade, which is great. Okay. Now, if we go back to the stocks here, we've now got 60. Okay. So even if we was going to go and add all these up and rank them by return on invested capital and earnings yield, it would still take a long time. Let's do some qualitative analysis. Now, I want to show you something that we've developed that gives you a massive unfair advantage. You know, this is a state-of-the-art innovative tool that is so powerful that I had developed because it shaved off months and months of work to put me at the forefront, give me such an edge that no one else had. And this is what I've been asked to talk about at the London Investor Show several times. I've showcased this at the London Trader Show as well. Main stage, you know, they asked me to talk about this thing because this is something that people just don't have access to. So I'm going to share that with you now. We're going to go to this little intelligent investing tool. And before I do that, what I'm going to do is I'm going to stick with these 60 stocks, and I'm going to hit this little download button here. And what that will do is download me a nice little CSV called America, right? Because we're looking at the American stock market. Now what I'm going to do is I'm going to click this button on my tool to analyze those stocks. I've got some instructional video here, but I'm going to upload that file that I just downloaded, okay? And what this is going to do in less than a second is analyze all of those stocks exactly how I just explained for the magic formula, but it's also going to calculate the Graham number on all of them as well, okay? So let's see what it does. Analyze America. Boom, done. Okay, straight like that. We've got magic formula rank 1 to 5. Okay, now you might see some, some patterns here. Banking, finance, right? And if we go by Graham number and see what we produce by Graham number, you know, got some low Graham numbers here. Again, finance, right? We've got some transportation. So this doesn't just come from like ideas and opinions. This comes from real data. And unless you've got real data, and then you can apply qualitative analysis, which I'm going to share with you in a moment, you have no hope other than getting lucky in the stock market, right? So just for craps and giggles, let's go back to this stock screener. Before I show you the qualitative stuff, let's go back to this stock screener. And let's just say that we check the technical rating for strong buys out of these 60. Right. Okay. So we've got finance, transportation, finance. So out of those 6 companies, 1, 2, 3, 4 of them are finance transportation, right? Goldman Sachs, GS. Okay. Goldman Sachs, we can see it's got a low PB, a low PE. It's got, a 2.67% dividend yield, okay? And that's very useful to know. But now we need to perform some qualitative analysis. So to perform the qualitative analysis, we need to find the stock, okay, and then do it ourselves. We need to do it using the stock. Now that particular stock didn't come up first as a magic formula rank or a Graham number rank, okay? It just didn't, because this is what the tool's doing. However, we don't know what algorithm that TradingView's using here to give you this strong buy signal. What I do know is I want to trust my own data. I want to trust my own strategy, because I don't know why this is a strong buy. Okay, what I want to do is pick one off of my data, and I want to understand. I want to apply the qualitative analysis to that. Right. So I could pick one of these top 5 and I could say, great. Mercer International, Merck, that's great. Okay, we can then go and take a look at this. I'll see where GS is on this list, so we can just keep it similar to what's on TradingView, just so we can compare like for like. So I'm going to hit this button called Analyze. And now we're going to be doing some qualitative and quantitative, extended qualitative analysis. So first thing, these are based on Warren Buffett's tenets of investing: simplicity, omnipresence, omnipotence, timelessness, stability, and ownership. And that comes from the report that Warren Buffett produces each and every earnings season every year. And he makes that publicly available. And when you summarize it, it comes down to those things. So these are the questions that people neglect to ask themselves when they're investing. Is the business model simple? Okay, yes or no? Do you understand it? Is it a very simple business model? If it's a bank, it just loans money. Okay, it's got products which mortgages, loans, interest on other various products, ISAs, all these kind of things, right? Is it simple? Fairly simple. If it's Coca-Cola, very simple. It's a drink. Okay, very simple. In a can, you pop it open, you drink it, right? So you need to answer that, yes or no. Do you use the products yourself? So do you use Goldman Sachs? Do you drink Coca-Cola? Okay, this is what you need to be thinking about. Yeah, actually, I drink Coca-Cola. Or no, I don't use Goldman Sachs. Do you understand the products or services and how it makes money? So do you understand how it makes money on the products it sells? Because a lot of people say, well, McDonald's makes money on the Happy Meal. Well, they don't. McDonald's makes money on the land and the franchise, right? Because they own the land below and the roof above. And they make money on the upsells. So go large, right? That's where they make the profit, not on the actual burger. They have to pay to get clients, and that cost, that overhead, comes out of selling a hamburger. They don't make money on a hamburger. They have to sell the upsells and go large and the bigger meals and and changing the Happy Meal every week so that people come every week, so they've got a subscription product. So do you use it yourself? Do you understand how it makes money? Yes. Does it have excellent brand recognition? Brand recognition is like, take Apple, for instance. Apple over Dell, okay? Apple can charge 3 times what Dell can charge for a much better spec, okay? Apple, you get a worse spec. Dell, if you spent $3,000 on a Dell, you'd have amazing, like 3 times higher spec laptop than a Mac, okay? That's fair to say. However, people don't care about that. People care about that unboxing, that slow box that drops, and then the paper they peel off, right? And then the little Apple logo lights up in the coffee shop and they're part of the Apple gang. That's what they care about. That's brand recognition, and it's a very powerful brand. The Nike tick, right? So does Goldman Sachs have great brand recognition? That's a question you'd need to ask. Does it have pricing power? So can it just change the prices of its products without people just running away? If you go into a shop and pay £1 for a can of Coke, and then you go to another shop and it's $1.50, are you not going to buy the Coke because it's $1.50? Probably not. You probably keep drinking it. You probably just buy it anyway. Whereas think of like travel insurance or flight seats and things like that, right? You're chopping around, go compare the market, all these things. You just want to pay the lowest price, right? Whereas Coca-Cola, you want Coca-Cola. So they can put the price up and you'll still pay it. Same with Apple, all right? Good pricing power. Can it raise prices without customers defecting? So that's, same kind of thing. Is it relatively timeless product? So basically, Coca-Cola has been, for years. Goldman Sachs, yes. Timeless product. Was it selling the same product years ago? Yes. 10 years ago. Will it likely sell the same product in 10 years from now? Coca-Cola, yes. Goldman Sachs, maybe. It's not as strong. As we go into, blockchain, decentralization and things like that, it might change. The landscape might change slightly. Does the customer need to keep buying the product repeatedly? That's a good one, right? Tying them in, sustainable income. This is why it's called stability. If you couldn't sell your stock for 10 years, would you still love to own the business? And that's a really powerful question you need to ask, okay? Would you happily be an owner of the company for 10 years, even if you're not going to get paid for 10 years? Would you be happy to own the stock? And then we're performing quantitative analysis, okay? So this is the quality questions, and you can see for every point here, for every tick, we've given it a point. So we've got a relativity in our point scoring system, and I'll show you how that works in a minute. But then we're looking at return on equity below 20%. So we can just go over to our stock screener and go, well, is the return on equity below 20%? Yes. Tick. Okay, so we want to tick that. Return on invested capital sorry, more than 20%. Sorry, it's not more than 20%. Return on invested capital, more than 15%. We go over to the stock screen. I'm getting a bit excited here. Return on invested capital, more than 20%. No, it's not more than 20%. So we'll leave that unticked for now. Does it pay a dividend? Yes, we know it pays a dividend. And then we've got the current ratio, DE ratio, all these things. And then EPS, is the earnings per share trending smoothly up? So if I go over to Wolfram Alpha here, okay, and I just type in GS EPS, this is going to pull us up a little graph, earnings per share. And I'm going to go over the last, all data. I like to go long term. And I wouldn't say that is a smoothly trending upward EPS, earnings per share, would you? The earnings per share has been pretty volatile. Whereas if we go to, say, let's just say Google, Alphabet, right? Let's just try that. Have a look at that. I think you can agree that that's a nice, steady, trending earnings per share. Okay, so when you go back to our tool, we can say, well, actually, no, it's not trending up smoothly at all. PE ratio below the average over the last 10 years. Long-term debt ratio, could they pay off their debts in less than 4 years of earnings? So these are questions that when you apply these questions and you hit save, you've now got an intelligent watch list, an actual watch list that has relativity to other stocks that you're looking at, where you say, okay, well, when I hit 10 points or 13 points or 20 points, that is when I'll put my money in. And then, of course, you need a strategy to put your money into the market. And that is what I want to talk about now, because I am offering certain limited number of spaces into my investing mastery program. I never sell when I do these videos, but I have just released an investing mastery program. And if you want to get involved so that you understand exactly how to buy, you want access to my watch list, my stocks, and watch me analyze these so that you have like crystal clear knowledge and vision over the stock market, so you're an intelligent investor, then the link can be found below. There's only limited spaces. The link won't be there for long. We're going to take the link out when the spaces have gone. But I highly recommend you get involved, because now is the time to get involved in the stock market. And I wouldn't have done this whole video if I didn't truly believe that. And I certainly wouldn't have built all these tools and spent thousands of pounds doing this stuff and doing this video. So I hope you got value from it either way. I hope it stopped you taking stock picks and stock tips and made you stop and think. And I hope it's made you understand actually you can learn this stuff and it's not that difficult. So get involved in the program, and I'll see you in the next one.